Right, thank you very much indeed. Welcome to the House of Commons. Thanks for coming along. Tonight's debate is about tax and why we should care about tax in this debate on inclusive growth. So let me just ask you first, if we're trying to build a more inclusive economy, if we're trying to build a more inclusive country, why should we care about tax policy?
Tax, in my opinion, is the thing that has the greatest possibility of shaping the society that we live in. As a result, tax is pretty darned important as far as I'm concerned. Remember, you have two ways of looking at tax. You can either look at it as spend and tax, or you can look at it as tax and spend. Well, the reality is that actually, because governments insist on being paid in things that look like this, then actually they spend first to create these, and then we reclaim tax. Now that means that actually tax is really important because it provides a mechanism for governments to put into place their social, their economic, their fiscal, their industrial strategies. And they do that by literally choosing who they tax, what they tax, what allowances they give, what incentives they provide. So tax is really important because it is this mechanism for delivering the intention of government.
So over the last 30 years, we've done a great job at building this great global marketplace. Arguably, we've not built institutions that are strong enough to tax the new wealth that's been created. Is that part of the problem that we face today?
Yeah, we have a conflict. The conflict between the nation state, which is where we rest the right to tax, and international markets where people and capital and goods and services can all float free of the nation state. And so inevitably that gives rise to this tension. Who is where and what can they tax? And we need to reconcile that conflict. There are some who say, look, tough, if the nation state can't write rules which capture within its domain what happens there, well, that's its fault. But the reality is that nobody has ever found a way to write laws that are that precise. So we need to cooperate. Now, if I go back 30 years, and my hair will indicate that I've been around tax for more than 30 years, you don't get this white hair without having been around tax for a long time, then I will tell you that the degree of cooperation compared to 30 years ago is phenomenal. It's vastly better than it was. But is it as good as it could be? No. We are still making fairly small steps towards the big goal of sufficient international cooperation so that we can be sure that the right amount of tax is paid by the right person in the right place at the right time at the right rate. Now that's possible, but we've got to work harder.
And within this global economy, there'll be some countries, and we've been one of them for a long time, that will argue that in order to foster job creation, we need to cut red tape, we need to cut taxes. If one country begins to do this, the risk is that you trigger a race to the bottom on tax. Is that part of the problem we've seen over the last 20 or 30 years?
I haven't got a problem with cutting red tape. Actually, I think we're pretty okay in the UK now. The burden of tax administration is really not that great. And those who say it is are frankly living in a fantasy world. They should go and try living in some other countries and see what it's really like there. The problem is tax rate more than tax administration, really. And the problem is finding the income. Well, we've made giant steps forward. We've got automatic information exchange between tax havens and countries like the UK now, which I was told in June 2009, when you were still in government, was not going to happen. Well, it has happened. We are moving towards country-by-country reporting, which is going to hold multinational companies to account for where they earn their profits. That's, again, an enormous step forward. And we're just working out how to use that data, because it's only just coming online. So we have to understand that there's a lot which is just coming online. But that doesn't stop the fact that there are, as you put it, some states who are definitely going to try and undermine this process as we have tax competition. And we need to make it quite clear to those states that what they're doing is unacceptable. It's undermining the credibility of the whole system. It's actually bad for all of us because their small gain is an enormous cost to somebody else. And literally the spillover of that is going to be poverty, or a lack of opportunity, or the denial of education, or the failure to develop, or to prevent global climate change, which affects us all. All of those things will happen if we actually don't have the interaction that's necessary. So I think at the political level, a lot of countries have got over their isolated view of tax, and they're beginning to understand cooperation is necessary. We're on that trajectory. I hope we remain on that trajectory. Obviously, things like Brexit could disrupt that, but I hope they don't. Donald Trump's view of isolated America could disrupt that, but again, I hope it doesn't. If we remain on that trajectory of cooperation, we are all better off as a result, is the point. But persuading some states of that is obviously going to be a bit of an issue.
And part of the challenge in winning this argument is that we're not clear what the spillover effects might be when one country cuts its tax. We don't know how that will hurt its neighbours. And that's one of the inspirations for this paper you've written.
Well, the inspiration for the paper is the fact that we need to understand better how tax systems work as a whole. It's one of those subjects where, including in the tax profession, and I'm a chartered accountant originally, I've been a tax professional, you become a specialist in one area. I know plenty of specialists in not just capital gains tax, but the capital gains tax of land, because it's too complicated to do land and shares. They become micro-specialists, and tax tends to encourage this focus upon great detail. But in practice, we need to stand back and say, whilst we might have a good idea about capital gains tax, will that undermine income tax? Because actually, go right back to why in 1965 in the UK we introduced capital gains tax. It was to prevent leakage from income tax. Why did we have a corporation tax, a tax on the profits of companies? Because people were diverting too much of their income into companies to avoid tax. So they were defensive tax to protect the overall tax base. So we have spillovers within economies, and we have spillovers between economies. And we need to look at both quite seriously. Tax systems need to be integrated to achieve the overall social impact within the country that is desired, which is to let people do what they really want to do to best effect, to get on with their lives, to have the opportunity to grow their own businesses, to do the jobs they want, to invest as they want. And at the same time, we need internationally to make sure that we don't undermine that process by artificial relocation of assets to tax havens, for example, which have been a big problem and which have undermined the ability of many governments to collect the tax that is owing to them. So measuring these impacts is important because it lets us work out domestically and internationally where the problems are, and then say, look, you are creating this problem, either, for example, with national insurance. It's unlikely to be an aggressive tax, but it's one that could be damaged. Or it's one of the Channel Islands in the UK is undermining the UK tax system because it has no tax on corporate profits. These things are things we need to know about, assess, appraise, and discuss in a sensible way.
Now, one of the points that Colin Hay makes to us is that the politics of austerity mean that those who are on incomes that are supported by fiscal transfers, like tax credits, have been hit hard over the last 5 or 6 years, whereas hyper low interest rates mean that those who hold assets have actually done really well. And that's helped fuel a debate about the need for potentially new kinds of tax or different sorts of tax that might target wealth. Do you think this debate is making any practical progress at the moment? Is there a case for more wealth tax? And if so, how do you begin to think about putting them in place?
Well, I'm glad you asked me that, and you won't even know why yet. I actually had a chapter accepted for a book to be published by the World Bank on wealth taxes yesterday. Now, when the World Bank is discussing the need for wealth taxes, there's something, you might say, strange going on in the world. This is not somewhere that's recognised as a hotbed of international socialism, if I can be honest, but they believe that this is a direction of travel we have to go in. And so does the OECD believe that's important. And the IMF, if we talk about 3 organisations which are not hotbeds of international socialism, those are 3, but they are all discussing wealth taxes because of the problems that the massive wealth disparities in the world are creating. The wealthy don't spend, for a start. And therefore, if you want the economy to keep going, actually redistributing their wealth is not just a moral imperative, which it is for some. It's a fundamental economic imperative because you need to put the money in the hands of the people who will spend it. And at the moment, that isn't happening. But what we also know is that if we have more equal societies, capitalism works better because people have access to capital. And wealth concentration tends to deny access to capital, so innovation and entrepreneurship reduces, so the private sector does not work as well as you would want. It's quite harmful to innovation, and it's harmful to markets because people with wealth don't take risk. But we actually need risk takers to make markets work. So for all these reasons, we need to look at wealth taxation, not because we are being destructive of wealth, but because we're actually trying to liberate wealth to be used by those with the ability to turn it into the broader need of society, the greater social wealth, which we all depend upon.
How clear are the options for wealth taxes? Is this still a pretty new science?
Oh, wealth taxes come in a number of forms. You start off with the easiest, which is actually looking at the income derived from wealth. And we're not very good at taxing the income derived from wealth. We actually tax it quite lowly. I mean, if we just look at the UK, if you work for a living, you pay national insurance. Now, the effective combined rate of national insurance for many people is around 25% when we add in the employer's rate and the employee's rate. If you get the same equivalent income from wealth, whether that's interest or dividends or rents, you don't pay that national insurance charge. So your effective rate of tax on wealth in the UK is now much lower. Now, until 1985, we had an investment income surcharge. You actually paid 15% extra income tax to make up for the fact you didn't pay national insurance. So we could level the playing field between income derived from wealth and income derived from the work of the labouring person, however they labour, by hand or brain or whatever. So that is the first thing we need to do, is look at whether we've got a level playing field between different types of income. We haven't got horizontal equity at present, we need to create it. The second form of tax on wealth is when wealth changes hands. In other words, capital gains taxes in many cases, or stamp duties potentially. And capital gains taxes are frequently very low. That's obvious in the UK at present, much lower than income tax rates. And the argument is, oh, but this encourages risk-taking. Well, actually, it also encourages, I'm afraid to say, tax avoidance in a big way, because the big incentive is to try and recategorize your income as if it's a gain, and so not pay tax on it. I'm afraid to say Nigel Lawson got this right. He put the rates the same. He did give some allowances for inflation in capital gains tax, which I don't have a major problem with, but he made the rates the same. I'm afraid that's the basis of equity here. Again, horizontal equity, because he did give some allowances for inflation in capital gains tax, which I don't have a major problem with, but he made the rates the same. I'm afraid that's the basis of equity here. Again, horizontal equity, because at the end of the day, you're going to spend the same pound, whether it's from a capital gain or from income. So why should you get a preference for the capital gain from pounds? The pound from capital gains. The third type of wealth tax is a tax on the stock of wealth. Now, this is the one that everybody's run away from in the past. And the reason why they've run away from it is very simple. Because wealth could run away from tax. That was why tax didn't go near wealth. And that was because tax havens prevented you basically taxing that, because you would just relocate the ownership, even of land and buildings, of property. You would just put it in your offshore company and trust, and apparently you would then not be taxable upon it in the UK, even though the building was very obviously still here. Well, we're breaking that barrier down now. One of the accidental consequences of automatic information exchange on income, which we are now getting from tax havens, which has been the result of the campaign for tax justice, is that we're also going to identify where the stocks of wealth are offshore. Because in fact, as from 2017, most tax havens will be reporting to the UK, everybody in that place has got more than $250,000 of wealth. It's denominated in dollars, because that's the universal world currency. And so they're going to have to report back stocks of wealth to the UK if a UK person holds money in the Cayman Islands or Jersey or the Isle of Man or wherever. So because we're going to get this data, wealth won't be able to hide from taxation anymore. So we are suddenly in a position we can tax stocks of wealth. Now, Thomas Piketty, in one of the most notable books of this century so far on capital in the 21st century, he's arguing that we should have a global wealth tax. And even when he wrote it, I think that was a pipe dream. And I don't think that's a pipe dream anymore. I mean, so we started this conversation talking about the rate of progress over 30 years towards cooperation. Well, cooperation's gone far enough that we can now imagine a global wealth tax, which is why people like the World Bank are now willing to address the issue.
So, final question for tax reformers, what are the priorities for the next 3 to 5 years? Here in Parliament, what should members of Parliament be really championing when it comes to tax reform?
adequate resources for tax authorities is always my number one point.
Yeah.
Because you can have the best tax law and you can have the best assessment of what you haven't collected, but if there's nobody actually on the end of the telephone, on the end of the computer, knocking on the door eventually to get the check, then I'm afraid you don't collect the tax. So we need a properly resourced tax authority. We need to have the political will to tackle some of the problems. Some of the problems are just down to plain, straightforward tax evasion, and it's domestic, and like it or not, it happens amongst smaller businesses, and there is a bit of a political reluctance to take on small business, when in fact, actually, we should be taking on the cheats among small business, because that makes the honest small business have a much better life expectancy. Small businesses have a low life expectancy, largely because they're undermined by the tax cheats. So we should be using every mechanism we can to differentiate between the two, and that would mean, for example, identifying quite properly which companies are trading and which aren't, and chasing those who are not making returns but are trading. 400,000 companies a year don't submit corporation tax returns in the UK. To me, that's a travesty of justice which needs to be put right, and could be put right with right information exchange. Then we need to actually look at some of the international mechanisms that are now being put in place, country by country reporting, automatic information exchange, and make sure we know how to use and understand the data. There's quite a lot of work to do on that at the moment. At City University, we're working on some of those issues right now. I've been long associated with country by country reporting, and I'm working with the OECD on how we understand this data. Because all of this works like a smoking gun. The great advantage of it is it points literally in the direction of where there might be things to investigate. And the consequence of having enough people to understand and interpret it is that actually the taxpayer's behaviour is likely to change. I'm already told by large companies in the UK they're trying to get rid of their tax haven subsidiaries because they don't want publicity for them, and country by country reporting will give that publicity at the moment to tax authorities, we're quite sure in due course publicly as well. So I would be looking at those as major issues, and then I would be looking at the next steps, and spillovers are part of that. I think this actual idea is quite important because it's been little looked at. We've had some really innovative things. The Tax Justice Network Financial Secrecy Index has done a lot to highlight what's happened inside tax havens. But the relationships between states has been relatively little explored. I think if we could invest some more time and effort into this, we would actually discover that we will understand better domestic and international tax risk and mitigate it. So we would have more cooperative tax systems which would work better to underpin fair societies, underpin fair business, and that's vital to the wealth of society, reduce the stress between states and within states over the tax issue, and improve taxpayer compliance, which is the ultimate goal. With those objectives in mind, I think we've got plenty to do for the next few years.